A deep dive into the 401k space. I want to share with you what you always wish someone would have taught you about 401k plans, how they work, when to use them, how to use them, when to start taking money out, and how they should fit into your overall financial plan. We're going to start with the basics of the 401k. We're going to look at things like vesting, required minimum distributions, inheriting these accounts, taking money out, really the whole 9 yards. So it'll be a fun conversation. I think you'll walk away realizing that the 401k, when used in the right situation, can be a wonderful wealth building tool long term for you and for your family. So the 401k plan, very similar to 403b, thrift savings plans. Just keep that in the back of your mind. They all have slight differences, but at its core, 401k plans an employer sponsored retirement account, meaning that your employer opens up a 401k plan that's met certain requirements set by the IRS and by ERISA. So employment law and tax law governs 401k plans. That plan, assuming it's met these requirements, allows participants, in other words, employees, to save money for retirement. Now, some 401k plans only allow employees to contribute. Many, however, allow both employees and employers the opportunity to contribute through a matching contribution or profit sharing. This is when your employer decides typically one of two things. They either say, hey, we want you to have some skin in the game before we put some money in to match or incentivize you saving for your own retirement. Or if it's profit sharing, we're going to give you a portion, a percentage of the profits that the business or the organization has generated over the course of the last year, typically. And then you're entitled to that money only when you become vested. Now, vested is the key word here. Vested means, in most cases, that you've worked for that employer for a specific period of time. Depending on how the employer set up the plan, it could be 1 year, it could be you're vested immediately, right, day one. It could be 5, even 6 years down the road before you enjoy all of what your employer has put in. Now, remember, every dollar that you put into your own 401k plan, you're 100% vested in. So your own money, if you pop it into a 401k plan, take the money out, you retire, you quit, you leave, you're always entitled to your own contributions. But your employer's contributions, they may have a vesting schedule on them. Now, there's a few reasons that might be the case. And I've helped a number of employers actually set up and design 401k plans from the beginning. For example, a dentist office, there's a dentist there. He's got a few different hygienists and assistants. Sometimes those dental assistants will only work for a short period of time and then they'll kind of bounce around to different dental offices or different practices. And the dentist, in this case, was a sole practitioner, so just him and kind of a one-stop shop office. He wanted to make sure that the employees worked there for a required period of time so that they weren't just bouncing around. He wanted commitment, right? So we set up a 3-year cliff vesting schedule, which means that they had to work for 3 years. And if they only worked 2 years, 364 days, and then they left, they would get nothing from what the dentist put in the 401k plan. But if they worked a full 3 years, then they immediately become 100% vested in that employer's contribution. So every dollar that the dentist put in their 401k plan, they were completely entitled to if they were to walk or leave or whatever. That's a cliff vesting. So you come off the edge of the cliff and you're 100%. There are other types of vesting schedules. We might call them graduated or gradual vesting schedules, where you get a certain percentage over time. For example, with my first job at a large public accounting firm, there was a 5-year vesting schedule and you became vested. In fact, I think you had to work there for 2 years. So the first 2 years, 0%. After you worked there 2 years, you became 40% vested. After the end of the third year, 60. After the end of the fourth year, 80. And then after the end of the fifth year, you were 100% vested, meaning that every contribution your employer had put into your 401k plan, in the first 5 years was yours, and every additional dollar that your employer put in that 401k plan was yours as well. Now, I ultimately made the decision to leave that employer before the 2 years is up. And you may say to yourself, Rizek, how could you do such a thing? You left 40% of the employer match on the table. I will tell you, it's the best decision I ever made long term for my career, because I love being a financial advisor much more than doing large public accounting work. But you just want to be sure that if you're close to the edge of becoming vested, and it's just a matter of a couple of weeks or a couple of months, then it can be wise maybe just to kind of suck it up and become entitled to all the benefit that your employer put in as a matching contribution into your 401k plan. That's what vesting is, typically based on time. Now, let me speak for a moment on another form of vesting. This might occur for individuals who are in upper management, or maybe they have a VP role or higher in the business, and it may be vesting based on performance. Typically, this isn't the case with 401k or retirement plans, but I just want to speak for a moment because this word vesting also applies in the space of equity compensation. So if your employer is giving you stock, maybe stock, some of you have employers giving you stock inside the 401k plan, but let's just isolate that and say your employer is giving you stock outside the 401k plan. So maybe it's required, RSUs, restricted stock units, or stock options of some type, whatever it may be. Sometimes they may require you to hit certain benchmarks, not necessarily time-based, but maybe performance such as profitability. So if your profits are a certain dollar amount or percentage, maybe it's based on EBITDA, which is earnings before interest, taxes, depreciation, and amortization, or some combination of that, some cash flowing metric, in which case, once you hit it, then you become vested. But typically, when we're looking at the retirement planning space, it's based on a period of time that you become vested. Now, you're going to see on your statement, in most cases, your own contributions and your employer's contributions as a separate line item on your 401k plan statement. When your employer makes contributions to your 401k plan, they are going in pre-tax. Now, the law changed not that long ago to allow employees to direct their employer to make, in some cases, Roth contributions as an employer into their plan. But from the employer's perspective, for years and years, it's always been pre-tax. That's because when the employer makes a contribution to you, it's kind of like them paying you a wage, right? That's an expense that they would deduct on their income statement, on their statement of operations. And when they make contributions to your retirement plan, it works the same way. They get a tax deduction from the employer's side. We're not going to talk about the complexities that may exist if you tell your employer to make a matching Roth contribution. That'll be a conversation for another day. But just know that in most cases, when you're making a contribution to your 401k, regardless if you're putting the money in pre-tax, what we call a traditional contribution, or if you're making a Roth contribution to your 401k plan, odds are your employer's matching contribution or profit sharing contribution is going in pre-tax. And when the day comes that you decide to take the money out, maybe you've been contributing a Roth your whole life into your 401k plan, you may be in for a little awakening, recognizing that your employer's contributions went in pre-tax. And when you distribute that out, that will be taxable as ordinary income to you in the year that you take a distribution from your 401k plan. There's a third type of contribution that you can make. We have the pre-tax one, we have the Roth, and then there's a third called after-tax. Now, not all 401k plans offer after-tax contributions. In fact, not all 401k plans offer Roth contributions. Everyone that I've seen offers a pre-tax or traditional contribution, which is where you reduce your taxable income today, kick that bucket down the road, and then when you're in retirement, hopefully you're in a lower income tax situation, either because your income's lower or because Congress has kept low tax rates, which I think will be the case for the next few years. I mean, I just took a little peek at the House bill that Congress has kind of leaked, maybe released different people about some of the proposed legislation that might be coming down the road, but don't hold your breath because the Senate has yet to share what their ideas are on upcoming changes to tax policy and law. But assuming tax law stays the same and tax rates stay the same, then your hope when you make a pre-tax contribution is that you're in a high income tax situation today. You'll be in a lower income tax situation in the future when you take the money out, and you're able to kind of play the game from a tax perspective. Alternatively, if you're a big fan of the Roth contribution, then your hope is that maybe taxes stay the same, maybe taxes go up, whatever the case may be. Your hope is to generate tax-free income and tax-free assets so that down the road, you don't have to worry about what tax legislation will be or what proposed changes may be coming down the road, because those distributions coming out of your Roth 401k are tax-free. Now, for a moment, let me speak on this. When you take money out of a 401k in retirement, you've got to be 55 in many cases, sometimes 59 and a half if you roll it to an IRA. But assuming you retire from your employer who holds your 401k plan, if you retire and you're 55 or older, there's a special provision called the Rule of 55 that allows you to take the money out and not face an early 10% withdrawal penalty that would have otherwise applied had you taken the money out before the magical age of 59 and a half. So let me say it a different way. For most people, you work, you collect money in a 401k plan, and then when you retire, you start taking the money out. But odds are you've had a few different jobs along the way, and so you have a few different old 401k plans lying around. If you start taking money out of those old 401k plans before 59 and a half, you will get hit with a 10% penalty. But if from your most recent employer you've worked until the age of 55, you can start taking money from that 401k plan before the age of 59 and a half and not get penalized. So there's that 4.5 year window there. Of course, this is a moot point. If you're going to work until the age of 59 and a half and then retire, it doesn't matter. You can take money from IRAs, from 401ks, you're fine. Now, when it comes to taking money from Roth accounts, it goes without saying, but for most individuals, for most retirees, we are delaying taking money out of Roth 401ks or Roth IRAs for a while, because that's the growth portion of your portfolio. That's where you're going to have the stocks and the growth-oriented investments, because it's a tax-free account and you want those high performance, those high growth assets getting that tax-free treatment. But there is some special 5-year rules that apply to Roth IRAs and to Roth 401ks. I won't get into the weeds there on those, but just recognize that if you've just started contributing to a Roth 401k and retirement for you is right around the corner within 5 years or less, we want to do some planning to make sure that you have enough assets set aside in the right place and invested the right way, so that when the day comes that you do retire, you don't face any frustrations or headaches around some of these 5-year rules that apply to Roth 401ks and Roth IRAs. Okay, so let's recap. Contributions, we have traditional contributions or pre-tax. This is where the big chunk of 401k money sits right now. Roughly 8 out of $10 sitting in 401k plans have not yet paid tax. In other words, they're traditional dollars sitting in the 401k. Then we have Roth contributions. They make up roughly the other 20% of money inside the 401k plan across the United States. Now, there's this third contribution I spoke about earlier, an after-tax contribution. This is for individuals who are relatively high income and have already maxed out the contributions to their 401k. So there's a certain contribution limit you can put into your 401k. Typically each year it increases a little bit. This year it's right around $23,000. If you're over the age of 50, you can toss in an extra $7,500. If you're in your early 60s, they give you a few extra thousand that you can toss in as a catch-up contribution. And don't get me started as to why just in your early 60s and not in your mid or late 60s they have this additional catch-up. But you can thank I guess your lawmakers for designing complexity within the tax system and retirement plan. It goes without saying that once you've contributed that amount, you still have other options. And many 401k plans, assuming you work for a larger employer, So if you work for a startup company, it's probably unlikely they have this feature, but some 401k plans allow you to make after-tax additional contributions above that base amount that I've just described. We're talking you getting money up into the $70,000-$80,000 range, depending on your age. That's a ton of money that you can set aside for retirement, and it can continue to grow and invest for you. But the contributions that go in are on an after-tax basis. That's different than Roth. When you put money into a Roth, it goes in after tax, but it grows tax-free. However, when you put money into an after-tax 401k, it does not grow tax-free. It grows tax-deferred into the future. And then down the road, when you take the money out, the increase, the growth, is subject to tax at ordinary income rates, which, by the way, is worse than capital gains tax rates right now. You'd prefer to actually invest that money in a brokerage account outside of a 401k or retirement plan if you were going to park that money in the after-tax account within the 401k. So why am I bringing this up? Well, because this is the foundational piece for what we call, and buckle up tight, ladies and gentlemen, this is one of the, I think, the nerdiest terms in personal finance. The official name for it is the mega backdoor Roth. I know. Why'd they put mega in front of it? I don't know, but you can probably thank some nerdy CPA or certified financial planner for creating that name. The mega backdoor Roth is what allows high income earners to jam pack a bunch of cash into a 401k plan and grow tax free in the future inside of a Roth account. And it's built on the fact that they can make these additional after tax contributions. And the second piece is critical: Roth conversions. Right now in the United States, you can convert as much or as little as you want whenever you want to Roth accounts. Whether you do it within a Roth 401k or Roth IRA, it doesn't matter. And by making after-tax contributions to a 401k and then typically turning around and immediately converting them to Roth, that can allow you to get a ton of money. Like I said before, around the $70,000 to $80,000 range in a Roth 401k, growing for you tax-free. And by the way, unlike Roth IRAs, Roth 401k contributions do not have income limits. With Roth IRAs, if you make above a certain level, you're ineligible for a Roth IRA contribution. Yeah, you can do a backdoor Roth, but it's only $7,000 or $8,000 this year. Yippee. I mean, hey, every dollar counts, don't get me wrong. But if you already have money in an IRA and it's pre-tax, then doing a backdoor Roth for you high income earners probably doesn't make sense to begin with in the first place. But back to the 401k. It doesn't matter your income level, you can get money in. This brings us to the next point with 401k plans, and it has to do with testing. 401k plans have testing requirements that are built in. The law has requirements that demand that 401k plans of a certain size or structure have testing to make sure that they're fair or equitable throughout the year in terms of the employees that are participating. These tests may actually limit how much you can contribute. So the IRS may say, hey, you're only able to put this amount in, but because you're considered a highly compensated employee, an HCE, your 401k plan may actually kick money out of that 401k plan back to you in the year you made the contribution, because from the fairness calculations, and I won't get into all the math that's involved there, the 401k plan benefited you more than people who are not considered highly compensated employees at the organization. Now, there's ways around this, and I have a number of colleagues that specialize just in 401k plan design and maintenance. And so if this is an issue that you faced, if you're involved with making benefits decisions at your place of business, or if you're just sick and tired of having this money be kicked to you year after year and not being able to max out your 401k, let me know. Happy to kind of connect the dots for you and talk through some options that might make more sense. But just to realize that with just about everything out there, there are certain rules and laws in place, and it's like a game. As long as you understand the rules you can navigate that game to win and succeed. Now, of course, we never want to cheat, lie, steal, none of that. But there are some loopholes within the tax code, like there are with other laws. And as long as you stay within the black and white there's ways to design a plan or design a strategy to accomplish your goals. Sometimes it makes sense to do it. The pros outweigh the cons, and sometimes it doesn't. But something to consider there for those of you who sometimes get money back from the 401k plan when you're making contributions. It probably has something to do with testing and design of that 401k plan. All right, next up. Once you've got money in the 401k plan, please recognize it's up to you to determine how that money is invested and growing. Nobody cares more about your money than you do. Trust me. Now, your employer may have set up default options for you to put money in. And likely it's probably one of two things. It's either a money market account. So think like cash at the bank where it's earning pennies in interest. Maybe it's earning a few percent right now, but it's not really working and growing for you like money in a retirement plan should be. Or it's based on your age. So the year you were born, and there's a default option. Typically, it's some sort of target date mutual fund. A target date fund is a compilation of investments, and the older you get, or in other words, the closer you get to the year named in the fund, the more conservative those assets become. So let's say that you have a target date 2040 fund in your 401k plan, and that's the one you've been put into. You just check your statement, and there it is, 2040. You didn't choose it, but that's what they put you in based on your year of birth. The closer we get to the year 2040, so over the next 15 years, that fund will progressively sell stock positions and buy more bonds. On the whole, that's how most of these funds work. And that will happen for you over time automatically. Now, for some of you, that's going to be a great option. That's exactly where you should be. But not all target date funds are created equal. There are some garbage ones out there. They're just really expensive, low performing. There's a lot of fees built into them. And they're just not designed to accomplish what it is that you want to accomplish. Or maybe you're a little bit late to the game when it comes to saving for your own retirement. And you want to make sure that your assets are invested and growing appropriately for you. Target date funds may be way too conservative for you in your situation. On the flip side, they may be way too aggressive. So just recognize that the default option in your 401k plan may not necessarily be the right fit for you long term. So your employers can have a number of options. It might range somewhere between 10 and 30 different mutual funds for you to pick from. They're going to have some stock funds, some international, some bond funds. There's going to be a mix. I'm a big fan of low-cost index funds. You look at the data and the track record of a lot of different investment funds over a long period of time, and once you weigh some of the costs that are both implicit and explicit to these investments, you start to realize that the performance over a long period of time, in large part, is due to one, diversification, and two, low fees. And as long as you have both of those things, well, there's maybe a few others, but those are the two biggest offenders that I see, then I think you'll be headed in the right direction. So I would look for low-cost index funds. If your 401k plan has them, that should make up what I think to be the base foundational piece of your retirement savings. And then on the edges, if you want to explore with other things, knock yourself out, at a certain point, it makes sense to include other alternative investments into a portfolio. But maybe for the first few $100,000 that you're saving in a 401k, there's no need to make it complicated. But I'll tell you what, sometimes I'll speak to university students or new college graduates. I'll be invited to speak at conferences around the country. And sometimes when you're first starting to save your first 10,000 or your first 50,000, you're constantly looking for the latest and greatest new investment. And what's out there? How can I make my money work harder for me? How can I reach my goals just a little bit faster? And I will tell you, and it's not the answer you want to hear, but it's the truth. And if you have ears to hear, you're going to hear this. You should be more concerned with saving and building a disciplined, consistent investment strategy and less concerned with trying to pick and choose which particular stock or crypto or a mutual fund in your 401k is going to outperform the others. You just want some core principles to guide your investment decisions long term. Yeah, you might get lucky once or twice, but hey, this is your retirement we're talking about, and we probably don't want to be playing games with it. Now, if you're young and you're in your 20s, knock yourself out. Sometimes it's best to learn those tough lessons early in life so you're less inclined to make them down the road in the future. But just some wise counsel for you to consider. All right, so once you've got the money going into your 401k plan and you've got it invested, what's next? The next part is distributions. So this is when you retire. And actually, let me pause. By the way, when you make contributions to a 401k plan, you can change those contributions throughout the year. It's not like a one-time thing. So you can do, and typically it's a percentage of your income, but you can do all traditional, all Roth. You can do a hybrid approach where you do a little bit of both. Just recognize you can be flexible there. If you had a really high income year, maybe you sold your home, you sold some stock, you inherited a retirement account from mom and dad, and that's spitting off a lot of ordinary income, whatever. You may want those pre-tax contributions. You may want those traditional contributions because they'll reduce your taxable income in that year. And then maybe your income's lower. Maybe you go from a dual income household to a single income household and you're married and your spouse is staying home with the kids, whatever. Well, now maybe we want those Roth contributions. You may want to switch to lock in your tax rate today where you know exactly where it is and then allow that money to continue growing tax free in the future. And now you're locking it in a low tax situation. Okay, distributions. Like I mentioned before, we're just going to assume that you have a bunch of money in a 401k and you're 59 and a half or older. You can start taking the money out. Now, when you retire, should you leave the money in a 401k or roll it to an IRA? That's a great question. And maybe even a question that we should address before your decision to retire. When you leave your employer, the money in a 401k, you have a few options. One, you leave it right where it's at. Now, just recognize, depending on how your employer set up that 401k plan, if you have a certain dollar amount, let's say below 5,000 or below 10,000, that's pretty common. The 401k may actually push that money out of the plan and send you a check in the mail. When you get that check, don't sit on it for a long period of time. Either roll it into a new employer's 401k if you switch jobs and they allow you to roll over money into that plan, or move it to an IRA. Those are kind of the best choices in that situation, because otherwise, if you sit on that money for too long, it will be considered a premature distribution to you. And those distributions not only are going to be subject to ordinary income tax, the federal, and depending on where you live, the state level as well, but also that premature early distribution penalty of 10%, which is a gut punch if you're not expecting it. So if you have like kind of underneath $5,000 or $10,000, that may be something to be aware of. But for most of you, you have quite a bit more than 5 or 10 grand in a 401k, because a 401k, in fact, is where most Americans become millionaires. It's not in their homes. It's in their 401k plan. Now, at a certain point, maybe the equity in your home pushes you over that limit, or you have more than $1 million, whatever the case is. But the 401k plan, like it or not, that's where most Americans become millionaires right now. So you roll the money over from your 401k to an IRA, either because you're forced to do so by your employer, or maybe you just choose to do that because you don't like the investment options your 401k plan has, or the 401k plan that you had from your employer is just expensive. It's costly. There's fees that you're sick of seeing on your quarterly or your monthly statements, and you want to be in complete control. Maybe you just want to consolidate all those old 401k plans that you've collected over the years. You just want to have them all in one place in an IRA so it's easy to track and manage. I'm sure I'm not alone in saying this, and you may feel the same way here, but it can be frustrating to remember your usernames and passwords and all that for all these old retirement plans that you've collected over the years. And by moving money to an IRA and keeping it all in one place, it just allows you to keep track of everything, hopefully have a consistent investment strategy across all those retirement dollars. Because if you've got multiple 401ks and something changes in the economy or taxes change or whatever, it can be difficult to go in and make appropriate trades or changes to all the different investments you have. I'm a big fan, and I would say that in 9 out of 10 situations, it's typically advisable to move money from old 401ks to an IRA. So what's the other 10% of the time? That may be if you're trying to do a backdoor Roth. Maybe there's some unique liability that you face. There's certain liability protections over IRAs and 401ks, so that in the event of a bankruptcy or if somebody sued you, there may be some protections there. They vary quite a bit from state to state, so we won't get into the details there. But there's a few situations in which it might make sense to keep the money at the 401k, but on the whole, most times it oftentimes makes sense to roll it to an IRA. Because with an IRA, you're in control. Like I said before, remember with 401k plans, not all 401k plans allow for Roth conversions. That's just one example. They may limit you. They may say, hey, we only allow you to put in money pre-tax. And once it's in, you can't convert it to Roth. Well, hey, what you can do is take that money out from the 401k, roll it to an IRA, and then you convert as much or as little as you want to a Roth, and you don't have to worry. That would be something to consider if you get to that point where Roth conversions matter. Maybe you just have way too much money in your retirement accounts that's pre-tax, and you're looking at your situation today and seeing what's coming down the road and say, hey, boy, I'm good on the investment diversification side. Like, I don't have all my eggs in one basket. I'm invested in a lot of different things. But from a tax diversification standpoint, I'm a little bit out of whack. I have way too much of my retirement savings locked up in assets that will generate taxable income in the year I start taking the money out to live on in retirement, or when the government forces the money out, which brings us to our next discussion point, which is required minimum distributions, RMDs, if you want to be like the cool kids. With required minimum distributions, the government demands that when you reach a certain age, you start taking the money out so that they can tax it. If you hear my daughter, she's knocking on the door. She wants to be a part of the conversation, but we're going to keep going. Those required minimum distributions are a way for the government to collect more revenue, for them to tax you, right? Because remember, all that money that's been sitting in a 401k or IRA is money or income, really, that's been deferred by you and has not yet been taxed by the IRS. Well, if you're the government, you want to get a slice of that action sooner rather than later, and you've been allowing employees across the country to defer the recognition of income. In other words, delay paying you, the government. And so required minimum distributions is just one way among a few others that they force this money out so that they can tax it. I work with a number of families all across the country who, because of required minimum distributions, in connection with them being disciplined and saving in their 401ks throughout their careers, are now recognizing more in income and consequently income tax than they ever did while they were working. Yeah, that's the negative power of required minimum distributions. All pre-tax retirement accounts, IRAs, 401ks, 403bs, thrift savings plans, these retirement accounts have RMDs, required minimum distributions, built into them. And if you've been disciplined and saved, and the majority of the money you have for retirements and pre-tax accounts, a day of reckoning will come for you. Thankfully, based on some recent legislation, these required minimum distributions do not apply to Roth accounts. Roth IRAs, Roth 401ks, they do not have required minimum distributions like their counterparts, the traditional side of retirement accounts do. So what can you do to combat RMDs, and when do they start? And how much are we talking about here? RMDs right now, if you turn 73 this year, they kick on. And you have to start taking distributions. Now, in that first year, you have till April to get the distribution out without facing a penalty on top of the income tax liability associated with that distribution. But every year following, in year 74, 75, 76, you have to take that distribution out by year end. That distribution, like I mentioned before, is all generating taxable income for you in the year that you take it out. It's based on a table through your age. So the older you get, the greater the percentage is that you have to take out as a required minimum distribution. So when you start when you're 73, the percentage is relatively small. It's hanging around 3%. As you get older, it goes to 4%, 5%, progressively higher as you age. It's based on your previous year's ending account balance as of December 31st. The way they look at it is they look at what was your account balance in your IRA and 401k and all your other pre-tax retirement accounts. They take that number, divide it on a factor based on your age, and that's what you got to spit out. So if you've got a bunch of old IRAs and 401ks all over the place, you may forget that required minimum distribution exists. And I will tell you, this is a common pitfall that a lot of people make, is they forget they have these old retirement accounts. They may just have a couple of $1,000 or whatever, 10 or 20,000, whatever it is, but that can add up over time. And if you've got more than that, hey, that's even more reason to consider consolidating so that it's all in one place and you don't have to stress out too much that you're missing something and you're in compliance with the tax code. There's not very many fears or anxieties that are worse than breaking the tax law and being afraid of an IRS agent coming knocking on your door. Now, they normally don't knock on your door unless you're in some gross violation, but getting a letter from the IRS, it causes quite a bit of anxiety for most people. And I don't want that to be you if you forgot about an old required minimum distribution. Okay, how can we combat RMDs? We can do Roth conversions before they even kick on. So in between when you retire and required minimum distributions turning on, which like I said is 73, but right now the current law says at a certain point in the future, in a few more years, it'll be 75. By the way, it used to be 70 and a half, then 72. Right now it's 73 years old. In between when you retire in that age, it might be wise to do a series of Roth conversions, which is where you move money from the pre-tax IRA stuff to the Roth stuff. And like I said before, you can do as much or as low as you want, whenever you want. You just want to be sure that you don't do too much at once or too little. Because in those years in which your income is low, you want to be sure to fill up those little tiny low income tax brackets if it makes sense for your financial plan. Of course, it goes without saying, maybe it doesn't, that Roth conversions are not a good fit for everybody, every year of their life, in every situation. For some folks, we're doing Roth conversions for over a decade. For others, we may just do them for 1 or 2 years. And yet for others, we may never do a Roth conversion just because they put themselves in an advantageous situation, or maybe they plan on working for a longer period of time, whatever the case may be. But when we start to build a financial plan, which is looking at your cash flows that you need in retirement, where's that money coming from? Which investments are we selling and when? And then we layer on the tax side of things, we can start to see any gaps in your risks or any opportunities that you want to take advantage of and jump on. Because there's only really that short period of time. You cannot convert the required minimum distribution itself. So in the year you have RMDs turning on for you, the government's saying, hey, we're forcing this money out. We want to collect taxes on it. You can't say, hey, sure, I'll pay the tax, but I want to park that money in the Roth IRA. No, it's got to come out, and it can either sit in your bank account, which is what most people do. And I think that's foolish, unless, of course, you need the money to live on in retirement, in which case, by all means. But you can move it to a brokerage account, continue to invest it, and let it run from there. But you can't convert it. You can convert future years RMDs. So let's say you're 73 or 74 and RMDs have started kicking on for you. You can convert the RMD for 75, 76, 77 before you've reached that age. You can still convert the money that's within the IRA after you've pulled out the required minimum distribution. But the reason I say kind of the sweet spot for Roth conversions for most people is in that range is because when they retire, typically we see an income drop. And depending on when we file for Social Security, and let me just say this, I've realized over the years that most people think retirement and filing for Social Security are synonymous, or they happen at the same time. And that's just not the case. You can retire, wait a few years, and then take your Social Security benefit. And The same would be said for those of you who have a pension. There's a few of you out there. If you have a pension, you don't have to retire and start filing for your pension benefit immediately. It might, in fact, make sense to wait a year or two and live instead on money that you have maybe at the bank account or in a money market or CD, or maybe you have investments in a brokerage account. Maybe you have equity from an old employer that's been sitting on the sidelines for years and years. You might want to take from that account first, because from a tax efficiency perspective, you can get capital gains tax treatment on those investments if you've held on to them for more than 1 year. And when you do that, you keep your income tax liability low, all else being equal. So in those few years, when you've delayed the recognition of ordinary income, remember, ordinary income is the worst type of income, at least compared with capital gain income in most situations. When you delay the recognition of ordinary income, by the way, that's Social Security income, because roughly half of you that are on Social Security are paying taxes on that amount, and roughly half of you aren't. But I'm here to tell you, if you're listening to this right now, you are more than likely in the category that will be paying tax on your Social Security benefit. And I know you've heard Donald Trump talk about not taxing Social Security, but I'm here to tell you, we haven't seen anything of that in the recent House bill for the pending tax legislation that will be coming down the road. So I wouldn't hold your breath. We'll cross that bridge when we get to it. But if you can delay the recognition of ordinary income for a few years, live on other assets, like I mentioned, from a brokerage account or cash in the bank or somewhere else, then that can be the sweetest time to do Roth conversions and fill up those lower tax brackets. See, right now in the United States, we have kind of small, medium, and high tax brackets. The small brackets, that's 10 and 12%. And by the way, this is supposed to end at the end of 2025. The Tax Cuts and Jobs Act is slated to sunset. It's very likely we'll see some changing tax legislation, but I'm just going to give it to you as the law stands right now. We're not trying to play games and guess at what Congress will do with legislation in the future. But right now it's 10 and 12%. And then we get a big jump from 12 to 22%. That's a 10%. This is going to sound super nerdy. A 10% marginal increase in your tax rate from 12 to 22. Then from 22 to 24, small change, right? 2%. Then we go from 24 all the way to 32, 35, and 37 is the highest tax bracket as it stands right now. So you can see we got that small, medium, and high. We got from 12 to 22, that's a 10% increase. And then from 24 to 32, that's an 8% increase in your tax bracket. So if you're already in the low tax bracket, maybe in this year we've really been strategic on planning. We're delaying the recognition of ordinary income for you in that first year or two of retirement. Hey, let's fill up those no-brainer low tax rates at 10 and 12%. Lock it in, and now we don't have to worry about that money growing tax-free inside of a Roth account in the future. If you're on the edge, maybe you filled up the 12% bracket already. You just have rental income, business income, you have stuff kind of outside of your control maybe. Does it make sense to jump to the 22% bracket and do Roth conversions? Sometimes. Sometimes it does make sense to take that leap, take advantage of doing Roth conversions when you're in a low income year, but we want to model that out. We want to test it in a few scenarios. And that's really what financial planning is. It's testing different scenarios to see which ones provide the most favorable outcome for your goals. And then, based on the limited information we have, that's financial planning, we make our decision, we run with it. I just planted my garden last week. We've got peppers, tomatoes. The weather's been warm enough that we can get it in without the risk of frost here in Utah. There's a lot of things I can control in the garden. I can control where I put the peppers and the tomatoes and the cucumbers and the peas and all that. But I can't control the weather. I can control the irrigation drip lines that I have running through the garden because we live in a desert here in Utah. Now, I grew up in Arizona. That's a real desert, but Utah's a desert, I guess, because they don't get a lot of rain, relatively speaking. I can control those drip lines, but I can't control how much it rains. I can't control the bugs that may come and the pests. I can't control the heat and the temperature. And just like with financial planning, there's a lot of things we can't control. We can't control tax rates. We cannot control the market's returns. We cannot control tariffs, the economy. We can't control whether or not our Social Security is taxed or if our heirs will be subject to estate tax. But there are a few things we can control. And financial planning focuses on that to put you in the best situation in a number of advantageous and disadvantageous situations to make sure that you're comfortable, you can sleep at night, you don't have to worry about going back to work, you don't have to worry about running out of money or having the kids kind of take care of you in your old age. You've got your seeds planted in the row and you're ready to tackle them when the day comes. Okay, we've talked about vesting. We've talked about contributions to 401k plans. We've talked about investment strategies to consider. We've talked about required minimum distributions in retirement. The last two topics I want to talk about with you here. When you retire, like I mentioned, there's a specific order of operations in terms of where you start pulling money from to live on in retirement. It's unwise to just randomly pull money from this IRA here and that 401k there and this HSA and that Roth and this brokerage account, and cash in the bank. You want to have a clear and defined strategy if you want to save on taxes. Now, I don't know about you, but I love to save on taxes. And it's much easier to generate additional returns by just being tax smart than it is to try and generate additional returns without increasing my exposure or my risk in the investments. That's a complicated way. Let me simplify it. Complicated way of saying is it's easier to save on taxes than it is to generate higher investment returns over a long period of time. So for most people, it makes sense to take money from brokerage accounts first. Then we pull from IRAs, 401k second. Excuse me, got a bug in my throat here. And then Roth accounts last, those tax-free assets. Now, if you inherit a 401k or an IRA from someone you love, I'm going to talk from the beneficiary's perspective for just a moment. That IRA or that 401k that you inherit right now, let's say you've gotten it in the last 4.5 years since the passing of the law that went into effect in 2020. So 2020 and beyond, you got 10 years in most situations to take that money out. And every dollar you take out is taxable as ordinary income to you at your tax rate. So if you have multiple beneficiaries receiving those assets, maybe it's you and you've got a sibling and you're in very different tax situations, you are going to inherit very different amounts on an after-tax basis. So just recognize that's the case. Now, from the parent's perspective, is it wise, if you have two kids in this example, to just give each kid 50-50? You just split the 401k down the pipe? Maybe, maybe not. If you just want maybe an overly simplistic, fair, equitable approach, then yeah. But if you want to look at maximizing the amount of money that each child gets on an after-tax basis, then it can make much more sense to really look at all the different accounts you have, and maybe you give more of the tax-free assets to the kid in the higher tax situation, and more of the the pre-tax assets to the kid in the lower situation. I have a whole example of this in my book, Finance on the Fly, Simple Strategies to Build Lasting Wealth. I think you'll find it insightful and eye-opening. If you want to help your kids or your grandkids in life, if that's part of your plan, which is not the case for everyone, but for a lot of the people I work with it is, then you want to be sure you not only factor in who's getting what, but also the tax impact of what they're receiving. Because let's face it, who cares how much you have saved if we're ignoring taxes? What matters is how much you keep after you pay the IRS. My name is Rizek. I'm a financial advisor. I'm a CPA and certified financial planner. If you've enjoyed today's conversation, be sure to follow for more. Check out my book, Finance on the Fly, Simple Strategies to Build Lasting Wealth.